Hey guys, so if you're thinking about your college years, you might be remembering what it's like to have financial pressures, to be broke, to worry about getting a job, to worry about purchasing a car, phones and electronics and all these things that are part of maturing in today's world. What if you could give something to your kids or grandkids that would be an ongoing gift for their whole lifetime? Well, there is. I'm excited to bring this example to you with Denise Boivier, one of our high cash value experts, because she's going to share how she does this on a regular basis with her clients, setting up what we call juvenile policies. So most of her clients that set up a high cash value type of a policy also set up policies for kids and grandkids. And she's going to walk through how this is a gift that literally does keep on giving throughout their entire life. So really want to get into this. When Denise is finished, I'll jump back in, summarize, and offer you guys some action steps. Denise, take it away.
Thanks, Steve. Denise Boivier here from InsuranceandEstates.com. The topic today starts with a question that I believe most parents and grandparents ask themselves frequently. What would be a gift that would impact my child or grandchild's life long term? Something that would grow along with them. Most parents and grandparents want to do more than just purchase toys, clothes, and gifts that are here today and gone tomorrow. I am about to show you how you can truly have a life-changing effect on your child or grandchild's future. Now, many of our viewers have learned a lot about the concept of overfunding a whole life policy to maximize the cash value, sometimes referred to as infinite banking or high cash value life insurance. I'm going to show you how to utilize this dynamic concept for your children and your grandchildren. Before I go over the numbers, I want to address just two of the many benefits of this vehicle. Number one, it secures future insurability. And by this I mean, if for some reason your child or grandchild develops a health condition that is uninsurable in later years, they will still have this policy you purchased for them at a young age and also have the ability to increase their coverage through the guaranteed purchase option rider, which I'll explain in a moment. So their future family is guaranteed protection. And number two, it provides them with financial means for life-changing events, buying their first car, college, tuition, weddings, businesses, down payment on a house. Most of my clients purchase policies for their children. Let's just take a look at my example of one of my clients. Randy has 2 children. He wanted to be able to contribute anywhere from $100 to $600 a month total for both children. We designed this illustration for his 5-year-old son and his 3-year-old daughter. Now, insurance companies like to see equal coverage on all siblings. So this policy, the death benefit is $200,000. This is on the 5-year-old male. And he has the option, he has a premium range, an option to fund this anywhere from $92 a month to $335 a month. So if something happens and he needs to say, hey, I can't afford the $300 a month right now, he can back it down to $92. That's what's great about these policies, is the flexibility of the premiums, because we all know life happens. This illustration is showing him funding it consistently at $300 a month or $3,600 a year. Now, if we look at age 16, his son will have cash value of $42,804. So if he wants to buy his first car, that would be a pretty good start. At the age of 18, when he's ready to go into college, he will have cash value of $53,479. That's a nice chunk of money to help him, even if it's just to buy his computers and his books and whatever. That's all tax-free to him. The nice thing about these policies is that when we take a loan from this cash value, let's say when he's 16 years old, they take $40,000 out to buy a car. The $42,804 is still earning interest and dividends, even though he just took $40,000 out to buy that vehicle. That's one of the attractions of these policies. Unlike a bank, if you took $40,000 out of your bank account, it is no longer earning for you. But this is still going to earn interest and dividends and still continue to compound. If we go down to age 30, in his 30s, when maybe he is married and now he wants to purchase a house. At age 30, he now has in his cash value $202,346. So that would be a nice down payment for a house, or maybe he wants to start a new business. Whatever he wants to do, he can do. He has that available to borrow against. When we also, I want to mention, when we borrow from our policies, there is no payment structure. So if we borrowed for college, we don't have to worry about making a payment while we're still in college. We can pay it back later when we're working. It's entirely up to you when you want to pay it back, how much you want to pay back, if you want to pay it back at all. When we take out a loan, it is not coming out of the cash value, as I mentioned. It's actually being deducted from the death benefit. So if you never pay that loan back, the death benefit will just remain, if you borrow $200,000, the death benefit will remain $200,000 less. So again, tons of flexibility in these policies. To go even further down the line in their lives, let's say they have this all the way to retirement and there's really no reason not to keep this policy once they have it. Let's say they want to retire at age 67. At age 67, their cash value is $1.5 million. So he will be able to retire. He can start taking an income stream for that. He can just borrow from it or however he wants. But it'll be available to him, for him to have as a tax-free income source. So as you can see, this is a gift that just keeps on giving. There are a lot of different things. I said I would mention the guaranteed purchase option. I put that on all of my children's policies. It allows them to purchase an additional, if he started out with $200,000, he can purchase an additional $200,000 each, pretty much every 3 years, starting at the age of 26, I believe it is. Until the age of 46, or until he reaches $2 million worth of coverage. And all of that is without underwriting. So if he should develop some uninsurable health issue, he will still be approved every 3 years to add that additional $200,000. So that is a really, really good benefit. Because like I said, life happens and we don't know, what's down the road for anybody. So this is just a quick overview of why it's a neat gift for our children and our grandchildren. They can, once they're of age, they can become owner of their policy. You can hand it over to them. But at age 67, again, he would have $1.5 million. His death benefit would be $2.2 million. And all through those years, he could pretty much have access to his cash value to use for whatever he needed it for. So that is basically what I wanted to show you today. And I'm going to turn it back to Steve, and he's going to give you some highlights on what we discussed. And I hope to hear from you soon.
Thanks, Denise. So I hope you guys could see through that example what a powerful thing that this is for any young person, as they have these guaranteed accrued cash value amounts that are available to them literally throughout their entire life. So we saw from Denise's example, at age 16, about $40,000 available. At age 18, about $53,000. At age 30, about $200,000 available. Finally, at age 67, $1.5 million available for what we call retirement planning, tax-free retirement. We've done a lot of other webinars on that topic. Just to imagine what it would be like as a young person, having those amounts available and be able to take policy loans for those amounts, pay back your policies. We often talked about it's really an infinite banking strategy for kids. They can pay back those policies. Also, really important point, Denise included a guaranteed purchase option, which she typically does on all of her policies. And this allowed the younger person to have a right throughout their entire life, really through their 40s, to purchase additional coverage on top of what the gift giver purchased in the first place. So just a very powerful strategy, thinking back to my own college experience and what that would have done for me. If this is interesting to you, there's going to be a calendar link below wherever you're watching. You can schedule a one-to-one with Denise, look at your own numbers and given your budget and see how that's going to look. Also, if you do have questions and comments, go ahead and leave them in our comments section. We will respond to the comments as long as you keep it classy. Thanks so much for watching, and I'll see you in the next one.